Hey, what's up guys? Welcome to another episode of Real Life CFA. So today's topic is credit default swaps. What is a credit default swap? A credit default swap is a financial derivative or the contract that allows the investor to swap or offset his or her credit risk with that of another investor. So a CDS can effectively hedge credit risks, meaning that the product itself bets against a certain type of credit product, such as bonds or basketball bonds. So this is how it works. If an investor buys a CDO from a bank and the recent market volatility makes the investor uncomfortable with the credit risk that the CDO has, this investor can go to the bank and buy a CDS with the CDO as the underlying asset. Meaning if the CDO goes bad, the bank will have to pay the investor to compensate for the loss of the CDO. So CDS is an insurance against default. So in this scenario, the investor hedges the credit risk of the CDO by purchasing CDS from a bank. Speculators can also bet against the credit market by purchasing CDS alone. It's just like shorting the credit market or a certain credit product. The Big Short is a great movie explaining CDS and CDOs. I hope everybody has watched it. If you haven't, I highly recommend it. So in this movie, the main characters Michael Berry and Mark Baum used CDS to bet against the housing market. So in the end, when the housing bubble burst, they made a lot of money off those CDS because the underlying CDOs became garbage and most of the mortgages went bad and defaulted. So whoever bought CDS at that time gets compensated, gets paid from whoever sells them the CDS. And in 2020, when COVID-19 first started to spread in North America, Bill Ackman bought CDS to hedge against credit defaults because he thought the pandemic would be so bad that would force our economy into recessions. And he was right. So he made a profit of $2.6 billion from his CDS trade, where he only spent about $25 million. So it was a 10 times profit. CDS as a derivative, it can be highly leveraged. That's how Bill Ackman made $2.6 billion from only $25 million investment. But the product was designed to be an insurance, to hedge the credit risk of your holdings. If you're not holding anything and you're only buying CDS, then you're more like a gambler, more like a speculator. It will be very risky. So this is a brief introduction to credit default swap. I hope you like this video. If you do, please don't forget to subscribe and like this video. Thank you very much for watching, and I'll see you next time.